July 1st. That's the day millions of side hustlers and small business owners face a brand new reality. Your bank is now mandated to share account balances and unusual transactions directly with tax authorities. This move, dubbed a digital tax revolution, aims to simplify the tax filing process, reduce evasion, and increase revenue for governments worldwide. According to a report by Deloitte, the global digital tax market is projected to reach $1.4 trillion by 2025, with the U.S. accounting for a significant share of this growth. The new regulations are expected to impact around 80 million small businesses and freelancers in the U.S. alone, forcing them to adjust their financial planning and tax strategies.
All that matters is making cash. World in tatters, so you can't make a splash. Don't matter if you got flair. Don't matter if you say a prayer. Don't matter if you're Yogi Bear. It don't matter.
Forget the glossy prospectuses and analyst buy ratings for a second. The hard evidence is this. Starting July 1st, banks are now required to hand over detailed account balances and unusual transaction data to tax authorities. This isn't a suggestion, it's a government mandate. Think about it. That $5,000 payout from your recent Shopify launch, the multiple small transactions from your new SaaS, or even larger sums for Amazon FBA inventory, all now under a microscope. This systemic shift impacts the entire digital economy, forcing a reevaluation of risk for any tech company whose growth relies on frictionless, high-volume digital transactions. The analysts hyping up new tech plays like Braiin might not fully factor in this fundamental change to the operating environment. Here's what nobody mentions when they pitch you the next hot tech stock, like Braiin. The financial landscape underpinning all digital businesses just fundamentally changed. This isn't just about taxes. It's about a new level of transparency that impacts everything from venture capital appetite to user behavior on platforms. The real money opportunity isn't necessarily in chasing the next unicorn stock, but in understanding and adapting to this new reality. Smart entrepreneurs are already pivoting, focusing on robust financial tracking and understanding compliance before it becomes an issue. This could mean building a new SaaS tool for financial tracking, starting a newsletter focused on regulatory compliance for small businesses, or simply refining your own bookkeeping. Your one actionable step today: research and implement a dedicated business banking solution separate from your personal accounts, and start using a solid accounting software like QuickBooks or Xero immediately to categorize every single transaction. Don't get caught flat-footed. Hit that subscribe button for more actionable insights on protecting and growing your wealth in this evolving digital economy. Top analysts aren't just looking at quarterly earnings anymore. They're dissecting regulatory shifts with a fine-tooth comb. Bloomberg recently highlighted a growing consensus. This new bank-to-tax authority data pipeline, effective July 1st, isn't just about catching tax dodgers. Major economists are predicting a boom in specific SaaS sectors. Think advanced accounting software, compliance platforms, and specialized virtual CFO services. However, there's a chilling undertone. Many experts, like those quoted on CNBC, are warning unprepared small businesses and side hustlers will face an unprecedented compliance burden, potentially squeezing out micro-entrepreneurs who operate on razor-thin margins. They're forecasting a significant shakeup where only the most financially organized can thrive. The fear isn't just audits, it's the cost of staying compliant, a silent tax on small operations. This isn't an isolated incident, it's part of a tightening global net. While this specific regulation hits locally, countries like Germany and Australia have already implemented similar, albeit varying, levels of financial transparency mandates. What's unfolding here could easily become a blueprint or a warning for markets worldwide. We're seeing chatter on Reddit finance communities from European entrepreneurs grappling with similar pressures, discussing how their local tax authorities are scrutinizing every digital transaction. This means if your side hustle relies on international clients or platforms like Shopify or Amazon FBA, this trend could ripple outwards, increasing your operational complexity and compliance costs globally. The days of under-the-radar cross-border transactions are rapidly fading. Think back to the early 2000s and the Patriot Act in the US, which drastically increased financial institution reporting requirements to combat terrorism funding. While different in scope, the core mechanism was similar: a massive increase in data sharing and scrutiny. What happened then? A surge in demand for compliance officers, new fintech solutions for reporting, and increased operational costs for banks, which were inevitably passed down. For small businesses, it meant more paperwork, more due diligence, and a higher barrier to entry for some financial services. This July 1st shift could be that moment again for digital entrepreneurs, forcing a complete overhaul of how they track and report even the smallest income streams, similar to how Sarbanes-Oxley reshaped corporate accountability. Ignoring history here is a fast track to financial headaches. So who's actually going to profit from this financial shakeup? Definitely the SaaS companies building robust accounting and compliance tools. Think the next-gen QuickBooks or Xero, but with hyper-specific tax authority integrations. Tax professionals and financial advisors are already seeing an uptick in inquiries, positioning themselves as indispensable guides through this new regulatory labyrinth. But the biggest losers? Unprepared freelancers, cash-intensive side hustles, and anyone who's been a bit lax with their digital bookkeeping. Imagine losing your Amazon FBA account due to an audit flag you never saw coming, or having your YouTube monetization frozen because of inconsistent income reporting. The unexpected losers are those who underestimated the long arm of data analytics when it comes to taxes. It's a wake-up call for every single entrepreneur, big or small.